Hello and welcome to this special video feature with me, Rohan Manmana. Today we're going to be speaking about this very exciting topic called ELSS. And to give us more information on this topic with me right now, I have the Head of Investment Products, Mr. Gautam Kalia. Welcome to this feature.
Thanks, Rohan.
So as you may all know, this is the tax saving season. We are all looking for that long lost friend, the chartered accountant. And Gautam, today we're going to be speaking on this topic. So basically we all want to save tax. I know I want to. Is there a smart way of saving tax?
Yes, since we are talking about ELSS, I think that's one of the smart ways of saving your tax. ELSS is equity linked saving schemes. It's a type of mutual funds. Basically what that means is that you can look to create long-term wealth by investing in ELSS kind of schemes.
Right.
And obviously you get the tax benefit under Section 80C as well, up to 1.5 lakhs. So that I think is the primary motivator for most people to invest in ELSS. But actually the clear advantage of investing in something like an ELSS is that you have the opportunity to create long-term wealth after you invested and actually reap the tax advantage as well.
So Gautam, how is ELSS different from other tax saving investment options like PFs, PPFs and FDs?
So that's a good question, Rohan. So PF and PPFs and even FDs, while you do get the tax benefit, they are all providing some form of guarantee and assurance of your principal as well as the return.
Right.
And because of that, the overall return offered is very low. Sometimes it's basically just keeping pace with the inflation.
Okay.
So whatever you invest today, after 2-3 years or 5 years, whenever you're able to withdraw that money, you are effectively going to be able to afford the same things that you were able to today with that money. So that is unfortunate from limiting the options for most investors. ELSS on the other hand provide you more market linked returns. So obviously there's higher volatility, but that gives you the potential to earn higher returns. And that is something which very few investment options have under Section 80C, and that's why you see more and more people curious to know about ELSS and looking to invest in ELSS as a tax saving option.
Right. The lock-in period, that means if I invest my funds today, then I won't be able to access it for the next 3 years. Is that correct?
That's right. So there is a 3-year lock-in, which means that if you invested 1,000 rupees today, you would be able to access that money only 3 years from now. If you invested another 1,000 rupees a month later, you would be able to access that 3 years and 1 month from now. So it is basically you can't touch that money for 3 years, but after 3 years you can access the money anytime. Obviously you will be getting a valuation on a daily basis, so you'll come to know how your investment is performing on a daily basis, but you can't really do anything about that for the first 3 years.
So Gautam, does that make ELSS a closed-ended mutual fund?
Oh, that's a good question, and that's something that most people get confused with. Actually, ELSS is an open-ended fund,
right?
But it's a special type of open-ended fund where you can't touch the money for the first 3 years, but you can invest anytime. So you can actually do a systematic investment plan. For example, you can invest a certain amount every week or every month, which you can't do in a closed-ended fund. And after spending 3 years invested in the scheme, you can withdraw your money anytime, which means that you can choose not to withdraw the money for 5, 10, 15 years. So that flexibility is available to you. So most ELSS schemes are open-ended by nature and definition.
Right. So let's say if I want to make the most out of ELSS, how much do you recommend I should invest in it?
So I know customers, investors who invest more than 1.5 lakhs because long-term wealth creation is their primary goal, and they like certain schemes that are recommended or they're doing well, over other equity mutual fund schemes, because ELSS are similar to other equity mutual fund schemes. They are just, because of the 3-year lock-in, provide that additional tax benefit. So some investors actually invest more than 1.5 lakhs for the long-term wealth creation benefit, but most investors I see investing around 1.5 lakhs. Sometimes investors, what they do is they reduce the company contribution to PF, and maybe they've got some insurance or other investment already where they are getting that credit. Right. So they already see what credit they are getting, and the remaining maybe 1 lakh they invest in ELSS. So it really depends on your situation and your tax planning, how you've managed it.
Perfect. So what I want to ask you next is, what kind of returns can I expect from my ELSS investment?
That's a good question. Again, that's actually a very often asked question, and it's a tricky one to answer. But let me try and simplify it. So if you look at the ELSS return categories, you've had some ELSS schemes give about 8% over the last 3 years annualized. Some schemes have given about 15-16% as well over the last 3 years. But essentially, you need to look at it in a broader perspective. ELSS are like any other equity mutual funds, which means that they will give you returns linked to the market, and it really depends on what the market does. So our expectation, and the simplest way to put this forward is, what has equity performed over the last 20-30 years. That is one way to look at it, and tell you the long-term return of ELSS has been, let's say, 12% or 14% in some cases, depending on what tenor you're looking at. So I feel very comfortable telling clients that 10 to 12% is something that you should expect. I think that sets expectations correctly, and often clients find themselves to be surprised on the upside. Obviously, there is potential for significant downside as well when you invest in equity markets, and that risk cannot be ignored. The other way to look at it is look at how India is doing. So India is growing at 7% plus GDP, which is in real terms. It's not in nominal terms. So I get the nominal GDP after I add inflation to this number, and inflation roughly, if we assume at 4%, you're looking at a nominal GDP growth of around 11%. This is on the conservative side. So 11% is what India GDP is growing at, and most of that growth contribution is coming from corporate India, which means that if you're buying stocks of companies that represent corporate India, you're buying a share of the business, really, and you are getting rewarded for that share of business ownership in terms of growth of the stock. So that's why we say 10 to 12%, because it's in line with that. Usually it is a multiple, of that. That's what we call the PE multiple. But without getting too technical, really the answer is that 10 to 12% is a safe assumption to make over a long term, keeping in mind that there's a lot of risk involved, and you could end up with minus 20% over 3-year period as well. That's happened with the clients, and that is something that you have to keep in mind.
So Gautam, okay, let's say I got a good return on my investment, and now I want to withdraw some of the returns. Does ELSS offer me that flexibility?
So the ELSS, like any other mutual fund, has 3 options. One is a dividend, the second is a growth. The third one is a split between dividend, which is dividend payout and dividend reinvestment. So dividend reinvestment actually for ELSS is not a good option, primarily because the dividend that is reinvested is then stuck for 3 years, right? So you don't want to be in that situation. That's why you either go for a dividend payout or a growth option. The advantage of dividend payout is that you get some form of income, whether it's a quarterly or annual basis, and the advantage of growth is that you get the advantage of compounding. And that's where you're really able to unlock the potential of long-term wealth creation when it comes to investing in mutual funds, because that's really what you want to do. You want to unlock the value of compounding. You want your returns to generate further returns for you. Right. And since you're anyway parking your money for 3 years, and you may end up parking it for even longer, most people go in for the growth option in ELSS.
So Gautam, as you said, the longer I stay invested in ELSS, higher the probability of getting good returns. But what if, let's say tomorrow I want to withdraw my investment altogether? Will I be charged an exit load?
So there is no exit load. Obviously you can't withdraw the money before 3 years, but after 3 years you can withdraw the money without an exit load at any given point of time.
So 3 years seems like quite a long time, isn't it?
So 3 years, yes, it is a long time, but out of the Section 80C options, it's the shortest in terms of lock-in. So that is another plus for ELSS investors. But ELSS, that 3-year lock-in also works as a blessing in disguise. That's because many first-time investors into mutual funds and equity mutual funds end up investing in ELSS for tax saving, and that really gives them an understanding of what it is like to be a equity mutual fund investor, because you get to experience the market volatility firsthand. Right. And you can't do anything about it, because instinctively instinctively, when you see your portfolio down 10-20%, God forbid if that happens, you want to redeem and make sure that you don't lose any more. But in ELSS you can't do that. So then you ride the volatility, you experience it, you're able to take a more longer term view. Actually, even if you want to, it's really tough to implement, but that's something that you are able to develop. So that's why I say that it's a blessing in disguise.
So by now we know how ELSS helps us build wealth, but Gautam, I'd like to ask you, what really happens to that money which is invested in ELSS?
Oh, so what happens when you invest in a ELSS fund is that basically you're giving the money to a fund manager to manage on your behalf. So he invests in a bouquet of stocks. Usually the stock range is upwards of 50 stocks, so 50 to 70 stocks is the range of number of companies that he invests in, and these companies could be either large, mid or small depending on the strategy of the fund manager. Some fund managers decide to follow a diversified strategy where they buy stocks from each category. Right. Some places they focus more on the larger companies, some places they focus more on the mid and small, but really you are owning the shares of a basket of 50 to 70 companies. Right. And that is being managed on an active basis by the fund manager and his team.
So we've discussed that ELSS is market linked. That means there is a risk involved. What's your take on that?
Yes, absolutely. So that's what I've been saying, that there is risk involved, and the unfortunate truth is that if you want to generate returns higher than inflation, then you have to take some risk. And what risk basically means is deviation from expected return. You expect to get 10% every year, but you end up getting minus 10% every year for the next 3 years. But on a longer term basis, you should get that, because that is what the underlying companies are probably growing by, and that's why the stocks should also grow by that. So that's really the logic. But market risk is a reality, and learning how to cope with market risk, how to mitigate that in your portfolio, that's really our job as a distributor of mutual funds. When we engage with clients, make them understand why long-term investment makes sense, and why the probability of getting the expected return increases over the longer term.
Lastly, what else should one keep in mind while investing in ELSS?
So like I said earlier, I think what's important to note is that ELSS is like an equity mutual fund. Right. It's a category of mutual fund schemes, and it is meant for long-term wealth creation as well as tax benefit, right? So if you keep this in mind, saying that okay, there are two benefits to it, then you are getting into it right. You are aware that there is a market risk associated among other risks. In fact, SEBI has rated this as 4 in the risk spectrum. There's a 5-point rating scale, so most ELSS schemes are rated as 4, which is moderately high risk. All equity mutual funds are either 4 or 5, and that is something really important for investors to know. So I think that's what I'd like to leave you with.
So Gautam, that was quite an insightful take on ELSS. Thank you so much for your time today. It was a pleasure speaking to you.
Thank you, Rohan.
And if you viewers have any questions on ELSS, do share it on our social media pages and we'll be happy to help. And for all the updates on our stock market, do log on to our website sharekhan.com.